Guys, we will start in couple of minutes. We will start in couple. So a very warm good evening to all of you. Today, we will be starting with the most awaited topic of economics, that is monetary and fiscal policy. And I have received a query that after completion of session, for how many days will the recorded sessions will be available to us? I guess 6 months or 1 year. I'm not sure about it. Make sure you ask your counselor for the accurate reply to this query. Again, guys, I'm trying you to explain that I'm not associated with operations, I'm not associated with placements, and I'm not associated with internship and all those things. My job responsibilities over here is about teaching, training, and content development. So if you have any doubt related to curriculum, you can definitely ask me. I would be happy to help you out. But apart from this, please try to persist yourself or resist yourself from asking doubts related to something which is not related to the curriculum or something which is not related to the topic. Shall we start if you guys allow me? Yes, we will be covering that, Vishal, in our session on Excel. So the topic is monetary and fiscal policy. Well, when you heard the word monetary, starting with the monetary policies first, when you hear the word monetary, what is the concept that is coming to your mind? What is coming to your mind? Monetary is something that is related to money. Very good. So, so what is money and what is money used for? If I want to say what are the functions of money, can anyone list what are the functions of money? See, guys, I'm asking you this question and you should definitely think about it and be interactive in the class because these could be the questions that could be asked in interview as well. And apart from interview, this could be the question that would be asked in subjective exams as well. So you will have to be expressive about it. You will have to. Yes, I have got all the responses, MB. I will go with my explanation as well, and then you can cross check. So one of the function of money is very good. It is a medium of exchange. So SD has given a very good definition of money. Money is used for having all those things that we need. Money is medium of exchange for us. We exchange money with goods to get something that we need. Yeah, it has proven to be an replacement of barter system. Actually, currency has proven to be an exchange of barter system. Then it is unit of account. It is a unit of account. So if I mean I have 10,000 rupees, it helps me to analyze what amount of money do I have. So it is a unit which helps me to measure my money, or measure unit that helps me to measure my wealth. With this, money also helps me to store of my values. If I want to accumulate my wealth, if I want to save my wealth, money would be the option to store my value and save for future needs. Money is also a standard of deferred payments. What do I mean by this is, if I have taken credit, if I have borrowed some amount from someone, money would be the medium through which I would borrow that amount. And if I will repay that amount at a later date, yes, RN, if I will repay that amount at a later date, money would be used to repay that amount as well. Money, as I said, it is unit of account. It is used to measure value as well. Now, money should be fungible as well. Now, what I mean by fungible? 100 rupees, if let's suppose a good is available in the market for 100 rupees, for 1 rupees, sorry. And the minimum denomination in the market is 100 rupees. The cheapest good available in the market is worth 1 rupees, and the minimum denomination available in the market is 100 rupees. Will I be able to buy this 1 rupee good? Will I be able to buy this 1 rupee good, or one quantity, one piece of this 1 rupee good? Would I be able to buy this? Would I be able to? The minimum denomination is 100 rupees in the market. So we have just started with monetary and fiscal policy, and we are discussing that monetary policies are related to money, and we have highlighted the functions of money, that is medium of exchange, unit of account, and so on. You can have a read, and it is pretty much basics that we have not jumped anything further into. We are just discussing the topic about fungible now, PM, where I am highlighting an issue that if 100 rupees is the minimum denomination, uh, 100 rupees is the minimum denomination in your country in currency terms. Rupees come in the minimum denomination of 100 rupees. And if there is something worth 1 rupee, would you be able to buy one piece of this good? Let's say Alpenliebe chocolate. There is a chocolate or a toffee which is worth 1 rupee. Would you be able to buy it? So money should be fungible. What I mean by fungible, it should be broken down. It could be broken down into minimum possible value. That is 1 rupee in today's terms. Earlier we used to have 50 paise, 30 paise, 20 paise, all these things. And at a later date, all these denominations started uh, moving out from the economy just because of inflation. This amount didn't hold any worth. At the end of the time, what happened was printing cost of 50 paise was greater than the value that it stored, that is 50 paise. So that is why government stopped printing and stop minting this money. So paise is nothing but cents in dollars. So don't get confused, guys. Money should be portable in nature as well. I should be able to carry that money to wherever I move. It should be divisible in different denomination. It should be durable as well. So fungible means money should be broken down. So what I'm trying to say is, if you have 100 rupees currency, that 100 rupees currency should be broken down into 10 different parts. You should have a smaller denominations of currency as well, like 10 rupees or even 1 rupee, so that economy should function in true sense. The reason being, if you have AR, let's suppose if you have 100 rupees currency and if you want to buy 1 rupees good, you can't just buy 100 goods, right? You can't just buy 100 quantity. It won't be the ideal deal for you. So if you want to buy 1 rupee goods, if you want to buy goods worth rupees 1 rupee, what could you do if 1 rupees is not available in the market? Government has not minted any money worth 1 rupee. The smallest denomination is 100 rupee. You will have to buy 100 goods. Is this a good scenario for you? The answer is no. That is why the money should be fungible. It should have the lower denominations as well. Have you got it now, AR? AR, have you got it now? Perfect. It should be portable. It could be carried out to wherever we move. It should be durable as well. We should keep money. We should keep money we should be able to preserve money for a longer period of time. May it be hard cash or minted coins. Now, fungible. People are getting confused in fungible. Let's suppose you want you have 100 rupees in your pocket. Let's suppose you have 100 rupees in your pocket, and the smallest denomination, it means that smallest note in the market is 100 rupees note. Tell me, how will you buy one eclair that is worth 2 rupees? Eclair is nothing but a chocolate. How would you buy one eclair that is worth 2 rupees? How are you going to buy it? Those who are not getting fungible, please try to be attentive and please listen to this. If you have 100 rupees note in your pocket, that is the smallest denomination of note, how are you going to buy one eclair that is worth 2 rupees? We can provide 100 rupees note to shopkeeper and take one eclair worth rupees 2 rupees and go home. How would we able to get one eclair that is worth 2 rupees? Does it make any logic to get 50? So that is why we can't buy. So what I am saying is, fungible is nothing but this 100 rupees could be broken down into smaller divisible amount. That is, this 100 rupees should be broken down into 1 rupees of 100 coins of 1 rupees. It should be broken down into 20 coins of 5 rupees. It should be broken down into 2 rupees coin, 52 rupees coin. So that is what fungible is. So each unit over here should be interchangeable with every other unit. The very similar term is divisible. It should be divisible as well. You should be able to divide this 100 rupees into different parts. Now, are you guys clear with fungible? Guys, are you clear with fungible? It should be portable, durable as well. What I mean by durable, you should be able, the quality of paper that is used to print that money should be of good quality. Let's suppose you hold a 2000 rupees note, and if the quality is poor, if the money is not durable, yes, 80, you can say that. If the quality of paper that is used to print 2000 rupees note is poor, would you be able to preserve that 2000 rupees note for a longer time? And not only you, if you give that note to someone else, will that person be able to preserve that note for a longer time? Money changes hands, like, right? Money changes its hands. Money flows through various hands. So if it is not durable, would money be able to be preserved by the people? The answer is no. So that is why money should be durable as well. Now, now when money is defined, it is classified into two broad terms. When someone tried to define money, it was defined in two broader terms. Now, what are these terms? The first one is narrow money, and second one is broad money. Narrow money is called M1, broad money is called M2 or M3. Narrow money is called M1, broad money is called M2 or M3. Now, what comes under narrow money? Narrow money is classified or defined as most liquid form of money and financial assets. Most liquid form of money. Most liquid form of money. Like, what could be the most liquid form of money? Can I say currency is money? Or cash is money? Can I say my bank balance is my money? So, along with this, demand deposits, all these things comes under narrow money. Narrow money is used for transactionary purpose. If I want to buy something, I will use money as a medium of transaction. And for that, this narrow money will be used. I'll come to that, VK. I'll come to that. Those things are actually classified as broad money. While broad money is, now if you see, what is broad? Broad is this. And what is narrow? Narrow is this. So can I say that broad covers narrow as well as few different things as well? So what I'm trying to say is, what I'm trying to explain is, this is a broad lane. This is a broad lane. And this is a narrow lane. So narrow money is a part of broad money. Correct, PJ? Narrow money is a part of broad money. So everything that narrow money has will already be in broad money. But would it be all? No. Narrow money plus there would be few things over here and there that would also be the part of broad money. And let's say what are those things? But please try to understand the concept behind it. Everyone clear? I'll come to that example. So what I mean by this is, AK, that this cash, bank balance, and demand deposits are part of narrow money. So it would definitely be the part of broad money. So broad money would be currency, cash, bank balance, demand deposits, all these things. So have you heard about treasury bills or money market instruments? Along with along with narrow money, treasury bills, money market instruments, and those instruments that can be converted, those financial assets that can be converted into cash are my will come under the definition of broad money, are my broad money. Those assets that can easily be converted into cash will belong under the definition of broad money. Now, this could be fixed deposits, gold and diamonds. Most of you are saying gold, land, diamonds, jewelries. Actually, this is not the case because these are under the asset class which is called alternative investment, and these assets cannot be converted into cash very easily. Now, from here, there are term connects liquidity. Are you guys aware about liquidity? What is liquidity? Treasury bills are nothing but short period government securities. So someone is having a doubt in what are treasury bills. Treasury bills are nothing but short dated government securities. So consider them as government bonds. It could be short dated, it could be long dated as well. But the question is, these treasury bills are highly liquid. Money market instruments. So when you see the capital markets are classified into two types. I'll come to liquidity, guys. Just give me a second. Capital markets are classified into two types. One is one is money market, which and other is the, and again, when capital markets are classified, actually, if you see, I should name over here financial markets. Yes, I'm coming to treasury bills. The whole plot I'm building is to explain treasury bills, so don't worry about it. So when I classify financial markets, it is described into money market and capital markets. Money markets cover those securities which has maturity less than a year, maturity less than 1 year. On the other hand, capital markets cover those securities which has maturity greater than 1 year. Treasury bills can be a money market securities or a capital market security, but those securities which with maturity less than 1 year is called money market securities, like commercial papers. Now, what are commercial papers? Let's suppose I am Tata Motors and I need funds for 90 days. So, I will borrow funds from people or bank. I will borrow funds from institution or bank, and against it, I will issue commercial papers, which is a legal document that I have borrowed this fund at a particular interest rate, at a particular interest rate. Why institution would invest to Tata Motors to earn that interest rate, and why Tata Motors would take loan from the company to expand its business. So that is commercial papers, basically a type of bond. Similarly, commercial papers are very similar to treasury bills. It's just that treasury bills are issued by government, and commercial papers are issued by corporates. It is a type of fixed income security. They are generally not classified as bonds, but the function, the way that they work are very much similar to bonds. Okay, so what are treasury bills? If government wants to borrow an amount from people or banks, they would issue securities that are called treasuries, and these securities, when invested by people, are called treasury bills. These are highly liquid securities. Why? Because anyone in the world could default, anyone in the nation could default except government. Government has currency printing power, and they would be definitely be paying back your amount that they have borrowed. Now, the interest rate at which government borrow this amount and the return that you get at treasury bills are called RF. What is RF? That is risk-free rate. Risk-free rate. So this is treasury bills. Those who had doubt in treasury bills, are you guys clear with this? So treasury bills, it's basically simple NB. Everyone, those who are not getting treasury bills, consider as the loan taken by the government of a nation. So if Indian government wants loan from its people, if Indian government wants loan from its people, they would issue treasury bills. We will come to that as well, DR. The collateral could be the assets held by the President of India or the assets held by government, that are PSUs, and all the assets, the infrastructure that is held by government. Apart from that, the printing power, the currency printing power that government holds, that you could consider as collateral. Now, yes, PTS, hold on your thoughts. I am coming to. Actually, this is, guys, we are actually being diverted from our topic again. This treasury bills, bonds, and SGB, sovereign gold bonds. These topics are under fixed income securities. That is a very different module to be covered later. That is a different module that we could cover later. But since every one of you are asking, consider in a layman sense for now, in a layman sense, consider treasury bills are bonds issued by government or government securities. Bonds issued by government Bonds are nothing but debt taken by corporates or institutions. It could be government or non-government institutions. Sovereign gold bonds are bonds, basically a debt instrument. Sovereign gold bonds are bond, basically a debt instrument where the returns, are tied up to the returns on gold. The returns on gold. So if you are investing in sovereign gold bonds, you will get a fixed return, and along with that, you will get a return based on how gold prices perform in the market. Along with that, you will get a return based on how gold prices are going to perform in the market. Now, why would anyone invest in sovereign gold bond and not invest in gold directly? Because sovereign gold bonds are, in some of the countries, they are tax free. Sovereign gold bonds are tax free. So T-bills, PT, are you clear with T-bills, bonds and sovereign gold bonds? At least the basic difference. PT, are you clear with this? Perfect. Shall we go ahead? Don't worry, guys. Don't worry. We will discuss this in very much detail in fixed income securities. So don't worry about. Yes, yes, dear. Your chat is visible to me. Actually, there are lots of messages, so some of the chat might get ignored. So I'm really sorry for it because in the pool of messages, although I try to answer each and every question, but in case I miss anything, please just I would request you to repeat again. Okay. Moving to moving to the topic. Clear, guys, with narrow money and broad money. Basically, narrow money, that is M1 securities, are those securities which are highly liquid. Broad money, broad money, under it comes M1 securities along with M2 and M3 securities, which is somewhat less liquid than narrow money, which is less liquid than M1 securities. Yes, yes, you will get the PDF. Don't worry. Now come to fractional reserve system. Now, so someone is asking me to repeat SGB. SGB is not nothing but sovereign gold bonds. It means that you are buying a bond with underlying gold as an entity. So your return that you could expect from that bond, the return that you could expect by investing in that bond would depend on how gold has performed, how gold prices has performed in the bullion market. Okay. The examples of capital market could be stock market, share market that you need. It is then there are primary markets and secondary market. In primary market, there is initial public offering. In secondary market, shares are traded. So K, that is something which is again somewhat different from the topic that we wish to convey today, but still, forex market is an example of capital market. Then there is derivatives market. There is insurance market. All these comes under capital markets. uh, the one who asked about sovereign gold bond. Are you clear? SK, are you clear? Sovereign gold bonds are nothing but those securities where the returns are tied up with the prices of gold. Okay. Then there is fractional reserve system. Let's suppose there are 100 customers to a bank. these 100 customers, these 100 people, these 100 people make a pool of $1,000 million, $1,000 million. These 100 people make a pool of $1,000 million in their savings account. Let's say there is a bank, Citibank, which holds this $1,000 million of these 100 people. Now, this Citibank will have to give interest to these people since this bank is holding their money. This Citibank will have to give interest to these people. How is Citibank going to arrange for that interest? How is Citibank going to arrange for that interest? So some of you are saying, almost all of you are saying that this Citibank will provide loans to businesses or common people, earn, let's say 10% as interest, and and provide 8% as interest. The spread between these two, that is 2%, is the returns to Citibank. Are you guys clear with this? Everyone, what the idea till now is? You guys are saying that 10% government provides loan at 10% return, gives 8% back to the people, 2% is the spread, and that is the returns to the bank. This is how bank manages its profitability. By the way, what is the most profitable listed entity in India? Which is the most profitable listed entity in India? Which is the most profitable listed company in India? Priyanka is saying equity. Equity is nothing but a market. AL is saying Reliance, MRF, SBI, credit cards, ICICI. Earlier it was Reliance, but SBI, State Bank of India, has left behind Reliance and now is standing to be the most profitable business entity in India, that is State Bank of India. Now the question is, would government allow, first of all, before coming to the government point, please try to understand, would any logical bank like Citibank, if collected 1,000 million as dollar, will lend out 1,000 million? Can government lend out 1,000 million? That is 100% of what they have collected from their customers. Can government lend out that 100%? Government cannot lend out that 100%. That you guys agree with. So can I say there would be a fraction of this 1,000 million? Can I say there would be a fraction of this 1,000 million which the bank will have to reserve? Can I say there would be a fraction of this 1,000 million which a bank will need to reserve? And out of this 1,000 million, what percentage will be decided by? Will be decided by what percentage does the bank need to reserve? Will be decided by central bank, Central Bank of the nation, RBI in case of India. Now, this process where the bank is allowed to lend out a fraction of their total collection, fraction of their total deposits. This process, this system where bank is allowed to lend out, where the bank is allowed to lend out a fraction of their total deposit is called fractional lending. Fractional lending system. And the amount that banks are required to reserve are called reserve requirement or statutory liquidity ratio. The amount or the fraction that banks are required to reserve are called reserve requirement or statutory liquidity ratio. Now, tell me if bank lends money, if bank lends money, will the supply of money in the economy increase? Will the supply or circulation, not circulation, but supply of the money in economy increase? And also the circulation will increase with respect to it. But that would be in later case. If bank lends money, supply would increase. More the money that bank lends, more the supply of money in an economy. Correct? We will come to that as well, PJ. Just hold on your horses just a while. I don't want to throw some random concepts and you might be uh, confused about it. So I just don't want to introduce that concept now, but we will be definitely coming to it. So banks lend more and more money that would result to more and more supply in an economy. Correct? The more money that bank lends, there would be more supply in an economy. Now, the greater the money of supply in an economy, is it better for the economy? Is it better for the economy or would it be worse for the economy? If there is more supply of money in an economy, would it be better for an economy or worse for an economy? Let's keep it simple. Would it be good for the economy or would it be bad for the economy? The answer is some of you are saying good, some of you are saying bad. The answer is it depends. Depends on which depends on which phase of the economic cycle the economy is in. So if there is huge supply of money in the economy, people will have more economy. If there is more supply, it would mean if there is more supply, it would mean more money to spend. People will have more money to spend. If there is more supply in the economy, people would have more money to spend. And if people have more money to spend, if people have more money to spend, the demand would increase, the demand for the product would increase. If demand for the product would increase, the prices of the product would increase as well. And if prices increase, the value of money would fall. And this phenomenon is called inflation. Now, connect this with the concept that we covered in the last class, that is inflationary gap. Where, if you remember that this is my demand curve, this is my supply curve. When money is lent out, more money is lent out. When more money is lent out, there people would have more money, more supply of money, and more money to spend. It would increase the demand, and that would cause demand curve to shift to the right. And what was this phenomenon called as? What was the reason for this gap? This gap has shifted our GDP to right. This gap has shifted our GDP to right, but it caused a gap, that is inflationary gap, if you remember. Now, are you able to connect these concepts? This is called inflationary gap. Why? Demand was rising because of the huge supply of money, and that caused an inflationary gap in an economy. Everyone clear with this? Everyone? Are you guys clear with this? If there would be more supply of money in the economy, people would have more money to spend, and when people will spend money, people will demand new products and more products, more quantity of products. And when people will demand more quantity of products, the prices of the product will rise, creating an inflationary gap in the economy. Everyone clear? Now, moving to the next part. If central bank wants to increase money supply, what would they do? What would they do? Would they increase reserve requirement, or would they decrease reserve requirement? Would they increase reserve requirement, or would they decrease reserve requirement? They would increase the reserve requirement, right? They would want a more portion of that 1000 million. I am asking, if central bank wants to increase the money supply, would they increase the reserve requirement, or would they decrease the reserve requirement? They would increase the reserve requirement. They would want that out of this 1000 million more, and they want, guys, just a second. Think twice about it again. Think about it again. Yes, think about it again. So the question is, Shivam, please answer. If the central bank wants to increase the money supply, would they increase the reserve requirement, or would they decrease the reserve requirement? If they want to increase the money supply in the economy, they would actually be decreasing the reserve requirement. Please follow logic, guys. Don't follow me. Please follow the logic. Reserve requirement on the basis of bank. So they would want bank to supply more and more. Let's suppose reserve requirement is 10%. Let's say reserve requirement is 10%. Let's say reserve requirement is 10%. It means that out of that 1000 million, 900 million is available for supply. Out of this 1000 million, 900 million is available to supply, and 100 million, 100 million, 100 million is kept as reserves. Now, if the central bank increases the if the central bank increases the reserve requirement to 20%, 800 would be available for supply and 200 would be kept as reserves. So can you see, when reserves requirement or statutory liquidity ratio is increased from 10% to 20%, the supply of money is falling. I'll come to that as well, Kriti. I don't just want to. PJ also asked the same doubt. I just don't want to introduce that concept now. We will come to that. We will come to that in the next 5 minutes. Please hold on your thoughts for a while. Please hold on your thoughts for a while. When we will talk about the reserves, we will introduce that concept of repo rate. Now we are in the supply side. We are evaluating the supply. So if central bank wants to increase the supply, they would simply decrease the reserve requirement. They would want that bank reserve less and lent out more. Does this make sense? Guys, does this make sense, everyone? So simply, if you are not getting it, please try to explain, please try to understand that if reserve requirement is high reserve requirement would lead to less supply. High reserve requirement would lead to less supply. Bank will have to maintain reserve requirement, otherwise they will lose their license of banking. Are you saying if bank does not maintain their reserve requirement, will they go bankrupt? They will have to maintain their reserve requirement, otherwise they will lose their license for bank. If you want to do banking as a business in India, it is a highly regulated industry, and since you are collecting people's money, try to understand with this logic, that you are holding money of common citizens of India, and you cannot play with those money. You cannot risk that money. Okay, so it is ideally very important to maintain the reserve requirements. Guys, higher reserve requirement would mean less supply. Why I am saying so? Let's say this is 1000 million of cash that is being collected. Out of this 1000 million, let's say 10% is 10% is my reserves. It means that statutory liquidity ratio is 10%. 10% is my reserves. If 10% is my reserves, can I say the supply would be 90%? Can I say supply would be 90% if 10% are my reserves? If I want to increase the supply, guys, please try to understand. If I want to increase the supply, will I increase the reserves or will I decrease the reserves? When I make this 10% to 8%, the supply is now 92%. When I make it to 6%, supply is now 94%. On the other hand, when I change it to 20% reserve requirement, the supply is now 80%. So can you see, if you want to control this supply, you will have to, this is a remote for central bank. This is a tool with central bank through which it can control the supply. Like when you are watching a television, you control the television channel with your remote. This is a remote with the central bank through which it will control the supply of the money. Please try to understand this way. If the central bank wants to increase the supply of money, they would keep on reducing the reserve requirement. If they want to reduce the supply of money, they would increase the reserve requirement. And this is any standard supply to reserve. Actually, it is 10%. 10% is the standard statutory liquidity ratio. Now, the question is this the only way through which government would control the supply of money? The answer is no. The question is, what would government, what would not government, but banks, what would banks, what would banks do? What again, please try to understand this. What would banks do of this 10% of their reserves? What would bank do of this 10% of their reserves? What would bank do about it? This is reserves, so bank cannot lend out this money. The only money that bank can lend out is through this supply. So K is saying they would give bank loans. So let's suppose 100 million is the reserves available with the bank. 100 million is the reserves available with the bank. So central bank has asked the bank to reserve this 100 million. So what this bank would do is, this bank, that is Citibank in our example, would lend out this 100 million or keep this reserves of 100 million to central bank. The reserves that the bank hold, it would lend out to the central bank. Everyone clear with this? What would the bank do with reserves? And if so, PJ is not getting this. You sure? I'll explain again. This bank has 1000 million, PJ. Were you there with me till here? This bank has 1000 million with 1000 million with it as deposit. Were you there with me till here? Have you understood this? This were collected as deposit from the people. Now this, out of this 1000 million, let's say 90% is supplied, that is 900 million is being lent out to people. This is contributing to the supply of money in the economy. And we see that how supply of money is related to reserve requirement. Are you clear with this? Out of this 90%, 900 million will be supplied to people or lent out. Bank would give loan worth rupees 900 million, but remaining 100 million, what would the bank do about it? What would the bank do about this remaining 100 million? These are the reserves that bank need to maintain. These are the reserves that bank need to maintain as their reserves. This is the amount that bank will need to maintain as their reserves. Are you there with me? We are covering monetary and fiscal policy. PJ, are you there with me? Okay. Now this 100 million, that bank holds, what will bank do of this 100 million? That is the question, PJ. The question is, what will the bank do of this 100 million? The bank will provide this 100 million. The bank will be providing this 100 million to whom? Bank will be provided this 100 million to central bank. In case of India, RBI. And this is what we have discussed over here. Okay. Now RBI, who has larger money? It comes under monetary policy. All these things comes under monetary policy, as I ideally discussed that we will be starting with monetary policy first. So guys, please try to understand over here. RBI collects money. RBI, who has a larger sum of money? Will the central bank has more money, or different banks have more money? Yes, that is also one point. So one thing that bank would do is it can lend out that money to RBI, and other thing that it can do is they can, but guys, I wanted to discuss, everyone was being curious about repo rate, so I wanted to discuss about repo rate. I will come to cash reserve ratio. I will come to cash reserve ratio as well. Don't worry about it. So guys, RBI RBI has, who has more money? The central bank has more money, or the banks, or the corp, or the banks in the economy will have more money? No, the class started at 6:45 only. Would the central bank will have more money, or the commercial banks will have more money? So if commercial bank need money, can they ask from central bank, since central bank has more money? If commercial bank needs, can they ask it from the central bank? Yes, they can ask it from the central bank. So the rate at which central banks lends this money to commercial bank, central bank will be lending this money to commercial bank, that would be the repo rate. Because what is central bank? Central bank is nothing but bankers to the bank. Correct, it. Central bank is nothing but bankers to the bank. Now, if central bank reduces the repo rate, if central bank reduces the repo rate, commercial bank would borrow more and more money from central bank. Can you see this happening? If central bank reduces the repo rate, the interest would be cheaper. The interest would be cheaper, and commercial bank would borrow more money from central bank, and they can lend out more money at a lesser interest rate as well. So people would want more money from the commercial bank as well. So reducing the repo rate also increases the supply of money. Reducing the repo rate also increases the supply of money. Are you getting this, everyone? On the other hand, if central bank wants to take money back from commercial bank, so repo rate is nothing but the interest rate at which central bank lends the money to, or gives the money to commercial bank. The interest rate at which central bank lends out the money to commercial bank is repo rate. Prachi, are you clear with the definition? Repo rate is nothing but the interest rate at which central bank lends out this money to the commercial bank. Guys, are you clear with this? On the other hand, when commercial bank, if central bank wants to reduce the supply of money, if coming to that as well, yes, we will take a break, guys. Don't worry, we will take a break. So if guys, you are seeing, if reducing repo rate reducing repo rate would create a demand of more money or more loan for commercial bank. And if commercial bank would have more money, what they would do for it? They would supply that more money to the people. And if there is greater supply of money at a lower interest rate, the supply of money in the economy will increase. So guys, if you are getting confused, repo rate decreases when repo rate decreases, commercial bank borrows more. Everyone clear till here? If repo rate increases, commercial bank borrows more. Why? Because of lower interest rate. Yes, PT, I'm coming to reverse repo rate. Please hold on your thought for a while. We need to take everyone with us together, right? Yes, all notes will be available on LMS, don't worry. If repo rate is increased, interest rate has fallen down, commercial bank borrows more money. If commercial bank has more money at a lower interest cost, they would lend out more money to common people. And when the demand of money to lend out more money, if there is more supply of money, there should be more demand of money as well. And to generate this more demand of money, commercial bank will also decrease their interest rates. And if commercial bank decreases their interest rate, demand of money would rise and supply of money would rise. And that would create the more circulation of money in the economy. Again, more people with money spending higher, greater demand, rising prices, and inflation. Please remember this as a poetry. Every time the demand of a product increase, its prices rise and it would cause inflation, resulting in an inflationary gap. To fight inflation, to fight inflation, what central bank will do? Pull out the money from the commercial bank, take money out, take money from the commercial bank, and the rate at which commercial bank lends out the money to the central bank is called reverse repo rate. The rate at which commercial bank lends out the money to the central bank, it is called reverse repo rate. Okay. If government want to decrease the supply of money, if government wants to decrease the supply of money, they what they would do? They would pull back the money in the form of in the form of reverse repo rate from the commercial bank. So what they would do, they would increase the reverse repo rate. They would increase the repo rate. So commercial bank will lend out more money to the central bank. They would increase the reverse repo rate. In this case, reverse repo rate, Kriti, please try to understand. If central bank wants to counter inflation, so what is the difference? The difference is repo rate is the interest rate at which central bank provides the money to the commercial bank. Reverse repo rate is the interest rate at which reverse repo rate is the interest rate at which commercial bank lends out the money to the central bank. This is the difference. Guys, are you getting exhaustive? I know this is a bit confusing, but are you getting exhaustive? We will take a 5 minutes break and we will be back with a fresh mind if you want it. Okay, some of you are saying yes. Some of you are saying no. Okay. Since we are connected, let's just get done with repo rate and reserve repo rate. Now, we saw that when repo rate reduces, we saw when repo rate reduces central when central bank reduces the repo rate, there is higher inflation due to higher supply of money. So this was the first part about repo rate. Everyone was clear with this? Yes, to control inflation, central bank follow these practices. Also, we will see how they practice. This is one of the examples when there is open market operations as well. We will see that as well. So please try to be there with me. Everyone clear with the first part? Please let me know any single one who is not clear with the first part so that I can move ahead. If you are not clear with the first part, ask me to repeat. If you are not clear with the first part, please ask me to repeat. Comment repeat if you want me to explain. Okay. Shivam. Okay. I am repeating once. Please pay 100% of your attention. Please pay 100% of your attention. I am there. I am there in the first part. I have not jumped to the second part yet. I have not jumped to the second part yet. I have not talked about reverse repo rate yet. I will be doing that. Please roll on your thoughts. Let's be clear with the first part yet. Let's be clear with the first part and then we will be moving to the second part. So please try to understand, guys. Please try to understand with a calm and composed mind what is happening. When, let's suppose you are a banker. You want to be an investment banker. Let's say for a minute that you are a commercial bank. You are a chairman of a commercial bank, let's say HDFC Bank. Repo rate to run your bank, please try to understand, to run your bank, you need money, right? To run your bank, to start your business with the bank, you need money and you are borrowing money from central bank. Everyone clear with this? To run your bank, to start your business as a banker and to circulate the money, you need money, correct? And that money you have borrowed from central bank. Will central bank give this money for free to you? Guys, everyone, those who have asked me to repeat, please reply. Will central bank give this money for free to you? Can anyone go to central bank and ask for the money? No. Central bank would charge an interest rate for it. Central bank would charge an interest rate for it. And the interest rate that a banker or a bank would pay to the central bank for the money that they have borrowed from the central bank is repo rate. What would be that interest rate? Repo rate would be that interest rate that central bank would charge for lending out money to a commercial bank. Everyone clear with this? Everyone clear with repo rate? Now the question is, if when would you borrow more? When would you borrow more? There are two scenarios with repo rate. If repo rate is 10%, would you borrow more? Or when repo rate is 8%, would you borrow more? When would you borrow more? When interest rate is higher or when interest rate is lower? At 8%, you would borrow more because you would want a lower cost of debt. Definitely. When there is low repo rate, there is greater supply of money. Can I say that now? So you would borrow more borrowings will lead to greater supply of money for people whom you will lend out this amount to. Are you guys understanding this? More borrowings, more borrowings would create a greater supply of money, and greater supply of money would make available people with more money available to spend. If more money is available to spend, if more money is available to spend to you guys, demand would increase or decrease. If you spend more, would the demand increase or decrease? People are spending more, the demand in the economy will be increasing. Everyone, Shivam, are you there with me? Shivam, are you there with me? Please let me know. Now, if demand increases, wouldn't that increase in rise of prices? If demand increases, don't you think the prices would increase as well? And that would create inflation. So that is why reducing repo rate would create inflation. Everyone clear with this? Everyone clear with this? Now let's suppose the inflation is increasing in the economy. Let's suppose the inflation is increasing in the economy. The inflation, yes, we will take break. Let me complete with reverse repo rate. Let's suppose the inflation is increasing in the economy. Please try to understand. The inflation is increasing in the economy. Will central bank do anything about it, or it will let the inflation grow? Is increasing inflation a good sign or a bad sign? Is increasing inflation a good sign or a bad sign? Everyone, is increasing inflation a good sign or a bad sign? It is a bad sign for economy, bad sign for an economy. Now, if inflation is increasing in the economy, if inflation is increasing in the economy more than expected, central bank will have to do something about it. Central bank will take measures to control it. Central bank should take measures to control inflation. Let's say you are the chairman of RBI. Will you be sit quiet and keep watching inflation rising? No, you will do something about it, right? Now, what central bank would do? Central bank would ask the banks, central bank would ask the banks to give money to them. Central bank would ask banks, you have a greater supply of money. Central bank would say, banks, you have a lot of supply of money. Give me back my money. Give me back the money. Central bank would ask, give me the money. Give me the money. Central bank, that is RBI, will take loan. Consider this as a loan. Central bank would take money. Central bank would take money from commercial bank. When central bank wanted to increase the supply of money, they were supplying money to commercial banks, correct? When some central bank wanted to increase the supply of money, they were supplying money to commercial bank. But now, if the inflation is rising, they have to pull out money from the economy. They have to pull out money from the economy, and central bank this time will ask to give the money, ask the money from the commercial bank. Earlier, they were providing the money to the banks. Now they will take money from the banks. If they take money from the banks, will bank give them money for free? Guys, will these banks give them money for free? They would charge something, right? These banks would charge something from the central bank, and that would be reverse repo rate. And that would be reverse repo rate. So reverse repo rate is the interest rate at which central banks borrows money from commercial banks. This is practical when countries face that inflation is rising very much. This is one of the measure that the central bank follow. Reserve rate requirement today is, I guess, 10%. Now, if reverse repo rate is increased, commercial bank will supply more money to the central bank, supply more money to central bank. Money available with people to lend would be less. Money available with people would be less. People will be available with less money in their hand. Less money in their hand would make the demand for the product fall. And if demand for the product would fall, consider this, when the demand for the product would fall, prices will cool down. Prices will cool down. Getting this, guys? Have you got this? The whole scenario. Now, now coming to this reserves, where we saw that this reserves, out of this reserves, some amount the banks will deposit to the central bank. Let's say out of this 100 million, some amount, that is, let's say 20 million, is being deposited to the central bank. Correct? Now, the remaining 80 million should bank hold with themselves in cash. I am coming to your doubt, K. Please let me complete this. Out of this 80 million, are the commercial bank will hold some money in cash. Why do they need to hold this money in cash? Because if someone PP, I am saying that out of this 100 million that was reserved by the bank, out of this 1000 million, 900 million was lent out. We are left with 100 million now. Are you getting this PP? What will we do this with 100 million? As a banker, what we will do this with 100 million? We will, let's say, give 20 million to the bank, to the central bank. We gave 20 million to the central bank. Remaining 80 million, we will have to keep it in cash. Why? Why do we need to keep cash of 80 million? Because the people from whom we have taken this money, my savings account holder who have deposited their amount in my bank, they can ask me back that amount as well, right? So some amount I will keep it in cash as well. Please try to understand. Some amount I will keep it in cash as well. And the amount that I am expected to keep it in cash is also determined by central bank, and that is called cash reserve ratio. That is called, my friend, cash reserve ratio. So guys, are you clear with all your curiosities? Are all your curiosities answered now? All your questions answered now? Repo rate, reverse repo rate, statutory liquidity ratio, cash reserve ratio. Let's take a 5 minutes break and be right back. Okay, few questions are pending. Let's see. Those who don't want to listen can go. I have few doubts and I'll answer them while those guys who are on a break. Just give me a second. Thesis rate, then also banks would not borrow excessively and supply will be controlled. Increases rate, then also banks would not borrow excessively and supply will be in control. Yes. So reducing repo rate would also control the supply. Increase RBI will take less money from commercial bank. If reverse repo rate will increase, RBI wants to take more money out of the commercial bank. That is why they are reducing reverse repo rate. Reverse repo rate is in the hands of RBI as well. So RBI diverts the reverse repo rate as well. No bank, no commercial bank can determine the reverse repo rate. Reverse repo rate is also determined by RBI. Used as a tool to reduce inflation. Demonetization is not a tool to reduce inflation. Actually, there are various aspects to it. Demonetization is a rare term or a rare tool that is being used. And demonetization not only has the monetary benefits or monetary expenses, it also has some geopolitical factors involved in it as well. Yes, that is something which is related to derivatives. Let's not options, futures, and swaps. All these things are related to derivatives. Some portion of cash could be reserved by the bank, and this is why ultimately we are asked to maintain a minimum account balance. No, that is not the case. That why we are asked to maintain the minimum account balance. The reason for minimum account balance is banks is providing you with services, and bank can charge you for that, right? Bank has a right to charge you for that. So if you don't maintain, or if you maintain a zero account balance, then bank won't be allowed to charge you based on that. So minimum account balance is something that is not related. Derivatives is what is not something that is covered. Increasing cash reserve ratio is whether it is good for the company or country or not. Increasing cash reserve ratio, it means that company is fighting with inflation. That is actually not a good sign to be in, because government is trying to pull back cash from the market, increasing the cash reserve ratio. So if government is trying to pull out cash from the market, they are actually hampering the business activities and expansion of a particular economy. Give me a second. What has been covered till now? Please tell. Reserve requirement, repo rate, CRR, statutory liquidity ratios, all these things are covered in today's sense. Okay, next doubt, sir. Can you tell me when will the exam will be after completing with your CRR must be kept in the form of cash. It could be in the form of cash or it could be in the form of short-term securities. Yes, GA, central bank should also keep reserves, but the reserves with central bank that they would hold that they would hold can also be in the form of other assets. They could now there is this is something related to pegging. Central bank decides that how much currency can be circulated in the market. So for that they will have to keep the reserves. So the reserves requirement you might have heard earlier, gold was the reserves that was kept. Bullion, why anyone, any economy cannot, why GA, are you there or are you on a break? So GA, please try to understand why would anyone or any government could not just keep on printing money? Why could any business or any economy could not just any government could not just keep on printing money? Any central bank could not just keep on printing money? Okay, just give me a second. Let me just complete this and I'll get back to you. Why would, so I am covering GA's doubt where he asked that does central bank is required to maintain reserves? Yes, the answer is yes, they are required to maintain reserves, but the question is how they will be maintaining those reserves. So why, to answer this, let us question why a business or why an economy, a government or a central bank cannot just keep on printing money. Because to print a given denomination of money, let's say if a central bank wants to print $3 trillion of money, they need to have 3 trillion worth of gold or US dollars in their forex reserves, in their foreign exchange reserves. So, so if if the government or central bank wants to print more money to be circulated in the economy, they will need to have more reserves in the economy. So that is why reserve requirement is one of the criteria that suits central bank as well. Now coming to other doubts, give me a second. For 1 to 2, 3, you will be completed in next 1 month. Why CRR must be kept in the form of no for 1 to 2, 3. Yes, you will be completed in next 1 month. So can you tell me when will exam be started internship today class? Yes, we will change that class name to economics. Increase Increasing cash reserve ratio is good for the economy. I think I have given the answer for this. It would hamper business activity, so it is not the green flag for an economy. Today's class was on derivatives, but yeah, we have to complete economics because we are not done with it. So I will change the class name to economics. Can you tell me why CRR must be kept in the form of cash? It could be kept in the form of cash or it could be kept in the form of short-term securities. Can you see my web chat? I have asked a doubt. KK, I'm really sorry, but I have not got your doubt. Can you please just repeat your doubt again? Is made on every second Friday of the month at the rate 4% or around. Am I right, sir, or not? Actually, how CRR is announced, I'm not sure about it, although I'll get back to you by researching on it. Uh, if you want to have a more discussion on it, please raise a ticket about this, mentioning the same doubt, and we can connect over a one-to-one session. Value of money will be reduced. Value of money will be reduced when uh, increase supply price increase and again inflation. Just may I know when did this batch start, please? This batch actually started. It has been there has been 1.5. So please raise a ticket about it. I don't know which batch are you from, Nikamni. So please raise a ticket about it. Please go to your LMS and ask a doubt, and there you can find. It's like a live session when we will connect on Gmeet, and you can ask me your doubts. Yes, central bank pay that's money, and that is reverse repo rate. Yes, you got that mail about derivatives, but since we were not completed with economics, the class for derivatives was scheduled today. That is true. But since we are not completed with economics, we will have to complete with economics, right? So that is why we are discussing economics over here. Guys, everyone who went on break, are you guys back? Please let me know. Everyone who went on break, are you guys back? AK sir, are you back? So from here onwards, I am the one who will be taking all the lectures. Okay. Perfect. Now, what is what is money multiplier? Let's come to the concept of for interview preparation. Shilpi ma'am would be there to help you out. TB. Simply because if government would be out of reserves, PK is asking a doubt that why reserves are important for an economy or a government. Why reserves are important for an economy or a government? Simply because if government is out of their forex reserves, if government don't have their reserves with them, they won't be able to print out the money. And if the no government is able to print out the money, there would be no circulation of money in the economy. People won't be able to earn. If people are not able to earn, how would be they meeting their expenses? So that is why it is essential that every government should have their forex reserves. Now, now let's suppose that there are 500 people in an economy. Considering an hypothetical economy that there are 500 people in the economy. And let's say the annual spend of these 500 people, or let's say the monthly spend of these 500 people in an economy is 500 million. The monthly spend of the 500 people in the economy is $500 million. Okay. So my question is, will the government need, will the government need to print 500 million worth of rupees? Will the government need to print 500 million worth of rupees? No. The answer is no. Why? Because, because again, coming back to that example, that 900 million was supplied and given as loan. This 900 million distributed to, let's say, different people. When these people receive this loan, they will invest this in businesses or buy products out of it. Okay. When they spend this, when these people who have received this loan, they spend this business will get that amount. This business will get that amount credited in their bank account. This is nothing but bank deposit for a different bank, let's suppose. And this bank deposit, let's say, is given back to someone else as loan. So this cycle keeps on working. This cycle keeps on forming. And the summary, the concluding line is, income of one is an expense to other, and expense of one is earning for other. Now, can you see this? That if government or central bank reduce reduce reserve requirement, if government and central bank reduce reserve requirement, bank would have more money to spend. We were done with this. People will have more money to spend. Businesses will have more money to spend, more deposits in the bank account, bank will be available with more money, bank would be providing more loan will be taken by people, people will spending in businesses, businesses will be earning more amount, and there would be more deposits. So basically, can I state, based on this logic, can I state that now what is this phenomenon called? Money is changing hands, money is going from this hand to this hand, 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 from this hand to this hand. Can I say money is multiplying itself? Can I say money is multiplying itself? The same 100 rupees notes, let's try to understand, the same 100 rupees notes that I spent for getting a chocolate was taken by the shopkeeper. He took vegetable for it. The vegetable used that 100 rupees note for paying school fees of their children. The principal of the school or the owner of school distributed salary out of that 100 rupees note. So 100 rupees is just a hypothetical example. Those salaries are used by teachers for their living expenses. So can you see that this same 100 rupees notes is used by multiple people? The same money is used by multiple people, and this is what money multiplier is. This is what money multiplier is. Are you guys seeing that money is multiplying itself? Money is multiplying itself. Are you able to see this? Guys, are you able to see this? Money is multiplying itself. Do you guys agree with me on this? Do you guys agree with me on this, everyone? Now, now, can I say, can I say the lower the reserve requirement, the lower the reserve requirement, the greater would be the money multiplier effect? Can I say the lower the reserve requirement, the greater the money multiplier effect? If bank is lending a larger portion of its deposits, everyone in the economy would have a greater portion to spend, and a greater money multiplier would be observed. Can I say that, everyone? So can I say that lower the reserve requirement, higher the money multiplier? Based on that, money multiplier is equals to money multiplier. Formula for money multiplier is money multiplier is equals to 1 upon reserve ratio, simply because reserve ratio is inversely related to money multiplier. Higher the reserve ratio, lower the money multiplier. Higher the reserve ratio, lower the money multiplier. Are you clear with this, everyone? RK, which point over here did you didn't understand? Please let me know, because the last concept was started right around 15 minutes ago. So which out of these concepts are you not uh, getting it? Please let me know so that I can repeat that part for you. Okay, the very last one. Okay. So RK, if 10% is the reserve ratio, 90% is bank supplying money, 90% is the bank is what the amount that bank can lend out. Correct? If 10% is the reserve ratio, are you there with me till here? If 10% is the reserve ratio, 90% is the bank is the amount that bank can lend out. RK, are you there with me? If 10% is the reserve ratio, 90% is the amount that bank can lend out. Do you agree with me? If bank has more money to supply to other, someone will have more money to spend. If someone has more money to spend, it will be the opportunity for more earning for a business. If there is more opportunity for earning for a business, the bank account of that business will have more money. If the bank account of that business will have more money, don't you agree bank deposits will be higher in that particular bank? If bank deposits are higher in that particular bank, bank will have a more money to loan out to some other people. Do you agree with me? Do you agree with me that this cycle is formed? Now, when these people have, when bank will be able to supply more money, if and only if the supply is less, if and only if the reserve requirement is less, and if the reserve requirement is less, the money multiplier effect, this is nothing but money multiplier effect, the effect would be more. Are you getting this? Are you getting this, RK? If reserve requirement is less, then money multiplier effect would be more. And that is why money multiplier is inversely related to reserve requirements. Now, we saw SLR. You guys are aware with SLR, statutory liquidity ratio. Although it was to be introduced now, you guys were very curious about it, so I introduced it beforehand. Tell me, if government wants to control inflation, reduce inflation, would they increase SLR or would they decrease SLR? If government want to decrease inflation, would they increase SLR or decrease SLR? Consider SLR nothing but one form of reserve. If government wants to increase inflation or if government want to decrease inflation, government will increase SLR. On the other hand, if government want to boost businesses, increase employment, they would want a greater supply of money. In that case, would they decrease SLR or increase SLR? In that case, they would decrease SLR. They would decrease any reserve requirements, so there is more supply of money in the economy. So SLR rate, statutory liquidity ratio, what percentage of deposits should bank maintain in liquid assets? I guess it is around 18%, but please check once more. Please check once more and let me know. Statutory liquidity ratio. Is it 18%? I think it is 18%. SLR is, let's suppose you have received 1000 million in your as deposit. So out of that 1000 million, 18%, okay, minimum is 18%, maximum is 40%. Okay, so out of this 1000 million, the SLR ratio that bank will follow out of the range from 18% to 40%, they will have to keep it in liquid asset or cash. They will have to hold cash or liquid assets for it. Are you getting this? Aryan, are you getting this? Oh, sorry, who would ask the doubt? Nandini, have you got this? What is SLR? The percentage of your total deposit you need to maintain in liquid asset is your SLR. Now, why would anyone need money? Why would anyone need money? So, what is the reason for demand of money? So, based on economic terms, demand for money is classified into three types. transactionary demand, precautionary demand, and speculative demand. Transactionary demands means you want money to live your life, to have food, to wear clothes, you need money. That is transactionary demand of money. Precautionary demand, just a second, guys. Precautionary demand, on the other hand, is the demand of money for some sort of preparing ourselves for some sort of uncertainty and emergencies. And the third one is speculative demand. Now, in the long term, you will know that money will lose its value. Money will lose its value. As the time passes, money will keep on losing its value. So you invest and speculate money in such a sense that the money is able to increase itself, considering it at a rate of return VK, so you can raise a ticket about it and we can discuss if it is so. Money, where was I? So you invest and speculate with money in such a way that maintains its money maintains its value over time. So you expect the inflation return out of the money, or return greater than inflation out of the money, or some return out of the money, so that you wish that the money that you invest today does not lose its value over time based on the interest rate prevailing in the market. Now, these were the uses of money. Now coming to the one who manages this money in the central bank. Coming to the one who manages this money in an economy, that is the central bank. What does a central bank do? Central bank creates monetary policies, that is controlling demand and supply of money in an economy through managing interest rates, it issues currency, also through open market operations as well. We will see what are open market operations. Central bank is banker to the government and bankers to the other bank as well. If governments need fund, it will go to central bank. The objective of central bank is to provide financial stability. Would any central bank would any central bank want an economy to go in deflation? Would any central bank would want an economy to go in hyperinflation? No. So financial stability and price stability is one of the objectives of central bank. How central bank manage its forex? Guys, would it be okay if we just stretch our session till 10 minutes? Because the reason why uh, I want to stretch this is because we are already running behind the syllabus. And the reason why we are running behind the syllabus, because we have covered everything in depth. So would it be okay? Even I have not taken a break, but would it be, I have a different session lined up at 9:30 as well. So, but would it be okay if we take a short break, please? If we stretch the session for next 10 to 15 minutes, please. Sorry, not a break, but if we stretch the session from next 10 to 15 minutes. financial stability and price stability. And finally, forex management, that what reserves, the doubt that GA asked me. Gaurav, are you clear with this doubt? So forex reserves management is something that central bank looks into as well. Now, interest rate like repo rate, repurchase obligation rate, all these rates. Someone asking about bank rate, right? Someone asked me about bank rate. I think I missed to explain it. It skipped out of my mind to explain about bank rate. Who asked me about bank rate? What are the revenue sources of central bank apart from interest income? We will come to that as well. Now, bank rate is also the rate of interest that is charged by the central bank for lending the money to the commercial bank. But this is with respect to long-term rates. On the other hand, repo rate is with respect to short-term or overnight rate, short-term or overnight rates. On the other hand, discount rates are a broader term which is used for these interest rates like bank rates and repo rates. What are the revenue sources of central bank apart from interest income? What are the revenue sources of central banks apart from interest income? So if you see GA, central bank is not a for-profit organization. Central bank is like a regulatory organization who is there to maintain the financial stability and make out policies for the business. SK, are you clear with the bank rates now? For the economy to work. So central bank is in the is responsible for making or doing or maintaining the well functioning of the economy. How money is managed of an economy is what central bank is responsible for. There don't need to be any other revenue sources for central bank because central bank is not associated for revenue collection. If you are trying to understand, central bank is not associated to revenue collection. Central bank is not a for-profit organization. Revenues, income, expenses. Government has different sources of revenue, and central bank as a banker, which is a bankers to the government and bankers to the bank, is responsible to manage their money and circulate that money to the people. So this is how central bank manages it. Is the money which central bank lends to commercial bank are part of deposits made by commercial bank to central bank. Not necessarily it could be part of deposits, but this is a continuous process that is going on. The central repo rate is a overnight rate or a short-term rate for 15 days or 14 days. Something is like some short period. So the repo rates are revised periodically, and based on that, the transaction between reverse and both reverse repo rates are keep on going on between the government and the banks. Okay. Now, final point for the day. G, are you clear with it? With this? Now, coming to open market operations. Discount rate is a broader term used for. So discount rate, discount rate is nothing. Just consider this that bank rates and repo rates are an example of discount rates. Discount rates are rates used to discount future cash flows. you will be able to understand this in better terms when we will be done with time value of money. In time value of money, if you guys are done with time value of money, do you remember, guys, Shilpi ma'am might have taken time value of money for the new batch, and I have taken time value of money for the other batches. If you remember time value of money, there was a rate of return, right? That was discount rate. Coming to open market operations, I just need one slide for open market operations. Let me just delete this. If open market operations is nothing but process of buying and selling, government securities by central bank. Open market operations are nothing but the process of buying and selling government securities by central bank. Now, coming to example, Kriti, tell me an example. If government want to increase the supply of money, will they buy the security or sell the security? If they want to increase the supply of money, will they buy the security or sell the security? What happens when government buys the security? Government or central bank, sorry, not government, but when central bank is buying G6 or government securities, government security is coming to central bank and central bank is providing with the money. If you are buying something, you will have to pay the money for it, right? So supply of money is increasing. Government buys the security and increases the supply of money in commercial banks. On the other hand, if government want to pull out the money from the economy, government will sell the securities. Banks would have G6 government securities and bank will have to give money to the central bank. So this is what open market operations is. Open market operations deals with buying and selling of government securities. Are you clear with this, guys? Everyone? Guys, are you clear with this? Prachi is not clear with it. Prachi, tell me, if you want to have, if you want to spend more money in an economy, will you be buying things or selling things? If you want to spend more money in an economy, will you be buying things or selling things, Prachi? If you want to spend more, are traded in secondary market. Yes, in primary, both in primary and secondary market. If it is issued for the first time, it would be in primary market, but G6 are also traded in secondary market. I don't know whether the common retail participants are, there are government securities which retail participants can also invest in, but government would deal ideally with bank. Central bank cannot knock every door and go to sell securities to others, right? You will be buying things, right? So when you will be buying, when central bank buys government security, they spend money and hence the supply of money is increasing in the economy. On the other hand, when central bank sells government securities, they are taking money in exchange of it and pulling money out of the economy. Which makes supply of money to fall. That is how central bank manages the supply of money through open market operations as well. So open market operations are one more tool by the one more monetary policy tool used by the central bank. Okay. Now, one single thing that I want to highlight for the day. PJ, are you clear with this? All things that we saw interest rate, open market purchases, reserve requirement, all these things, if that is intended to increase the supply of money, it would be expansionary monetary policy. If all these things, all the monetary tools that we saw is with an intent to increase the supply of money, it would be expansionary monetary policy. On the other hand, If it is with an intent to reduce the supply of money in an economy, it would be contractionary monetary policy. Contractionary monetary policy. Okay. So with this, we are done for the day. For now, let's be back tomorrow and let's complete monetary and fiscal policy and move to the next topic of derivatives. I'll last thing about monetary contractionary and expansionary monetary policy. That is what you are asking, 80. That is what you are asking, 80. So if government is increasing the supply of money in an economy, they want an economy to prosper. They want people to spend more. That is an expansionary policy. What is an expansionary policy? If government want people to spend more, if central bank want people to spend more and increase businesses in the economy, increase transaction in the economy, they would increase the supply of money in the economy, and that would be the example of expansionary monetary policy. Yes, KG. Which batch are you from, KG? Based on that, it would be your course completion month. On the other hand, if people no, so you have still few more months left. You have 3 months more left, KG. On the other hand, if government wants to pull out money from the economy, they have to reduce the supply of money from the economy. It is the example of contractionary monetary policies. Are you clear? Are you clear, KG, with this? Sorry, not KG, but 80. Are you clear with this? Thank you, guys. Thanks a lot. Thanks a lot for being such a wonderful crowd. Thanks a lot for being so patient. The lectures will be taken by only me, TB. Shilpi ma'am will be taking your mock interviews. Shilpi ma'am will be taking your mock interviews. All the lectures will be taken by only me. So thank you, guys. I hope you enjoyed today's session. I hope you find the session very much interesting. I hope you love economics. So thanks a lot. Thank you. Bye-bye. Have fun. Enjoy your rest of the day. Bye-bye. Bye-bye. Yes. Thank you. Thanks a lot. No, tomorrow we will be concluding economics. If you want a suggestion for book, go for Indian Economy by Nitin Singhania. It is it is a very huge book, and it covers the economy with the perspective of UPSC level preparation. So that is the best book for economy. Even I have not read it, but I have suggestions from my mentors that you should read. You should read Indian Economy by Nitin Singhania. Thank you, guys. Thanks a lot. Bye bye. So no worries, PP. Don't worry about it. There is no book. Just one guy asked me for a suggestion that which is the book to master economy. AK asked me about it, and so I just suggested him a book. I won't suggest anyone to go for a book, and until and unless you don't want to be an economist. So that was all from my side, guys. That was all from my side regarding notes and PDF. Please raise a ticket. I won't be the best person to answer all those things. Bye bye. Take care. Have fun. Yes, it is interesting. Bye bye, guys. Bye bye.